What are the different types of mutual fund schemes? There are several ways to categorize mutual fund schemes. Let's check out a few of them. First of all, schemes can either be classified as open-ended schemes or closed-ended schemes. What is an open-ended fund or scheme? An open-ended fund or scheme means that it's open for business on all business days. You can invest or withdraw your money on all business days. Liquidity is the key feature of open-ended schemes. And what are close-ended funds or schemes? Close-ended funds or schemes have a stipulated maturity period. Example, 3 months, 6 months, a year or more. Unlike the open-ended funds that's open for business on all business days, close-ended funds are open for purchase only during the initial launch and for redemption at specified periods of time, either immediately post-launch or later, depending on when the AMC specifies. Mutual fund schemes can be classified according to the investment objective. Such schemes may be open-ended or close-ended schemes, as described earlier. Let's take a look at some variations. Equity funds. The aim of growth funds is to provide capital appreciation over a medium to long-term period. These funds invest in equity shares of companies and therefore offer the investor the potential for growth. Such schemes invest a major amount in equities. Equity schemes are suitable for investors having a long-term outlook, seeking appreciation over a period of time. Balanced funds. The aim of balanced funds is to provide the benefits of investing in both equities as well as debt securities in the proportion indicated in their offer documents. These are appropriate for those investors who are looking for growth without taking too much risk. These funds are also affected because of fluctuations in share prices in the stock markets. However, NAVs of such funds are likely to be less volatile compared to pure equity funds. Index funds replicate the portfolio of a particular market index, such as the BSE Sensex, S&P Nifty, etc. This makes tracking your investments simple and easy to understand. NAVs of such schemes would rise or fall in accordance with the rise or fall in the index, though not exactly by the same percentage due to some factors known as tracking error in technical terms. Necessary disclosures in this regard are made in the offer document of the mutual fund scheme. Income or bond funds. Income funds invest in debt securities such as bonds, corporate debentures, government securities, and money market instruments. Such funds are less risky compared to equity schemes. These funds are not affected by fluctuations in the equity markets. However, opportunities of capital appreciation are also limited in such funds. Income funds are generally preferred by individuals with a low risk profile. Money market or liquid fund. These funds are also income funds, and their aim is to provide easy liquidity, preservation of capital, and moderate income. These schemes invest exclusively in safer short-term instruments such as treasury bills, certificates of deposit, commercial paper and CBLO, government securities, etc. Returns on these schemes do not fluctuate much compared to other funds. These funds are appropriate for corporate and individual investors as a means to park their surplus funds for short periods of time. Gilt funds. These funds invest exclusively in government securities. Government securities have no default risk. NAVs of these schemes also fluctuate due to the change in interest rates and other economic factors, as is the case with income or debt-oriented schemes. Mutual fund investments are subject to market risks. Read all scheme-related documents and information carefully before investing.